Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 32 on October the 19th, 2018. I'm your host, Eric, and in this week's show, we will cover the trades from last week on CNX Resources, the SPDR S&P 500 ETF, and US Oil Fund ETF. And then we'll get into the three new trades this week on Caesars Entertainment, Advanced Micro Devices, and eBay. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me at eric@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. I also last week mentioned a option payoff graph that I have in Excel. I had a few of you email and ask for a copy of that. Definitely reach out to me. Of course, my email address again is eric@theweeklyoption.com. It's a great tool to be able to learn to visualize and understand option trading and where you make and lose money. So feel free to reach out. I'll share that file along with you, and I'm happy to hear from you. So this week we had a very volatile market, and after significant drops and a full-on pullback, the market essentially ended the week relatively flat. The Dow Jones Industrial Average ended the week up 104 points, finishing at 25,444 points, and the S&P 500 index rose less than a point this week over week, so it finished once again at 2,767 points. This week there are approximately, or I believe just exactly, 703 companies that I am aware of that are announcing earnings. So this is one of our first huge earnings weeks. We'll probably see numbers similar to this for the next couple weeks. For those of you who don't track stock movement around their earnings, you're missing out on an opportunity. For instance, last week I mentioned that Procter & Gamble would be announcing their earnings this Thursday, which is yesterday. Today, that stock rose $7 per share. That's nearly 9% move on a blue chip stock in one day. PayPal and several others also had huge earnings, huge moves after their earnings. I think PayPal was up a little more than $7 today as well. So that's one of the reasons I watch these earnings updates, is because they create opportunities in the market. So this upcoming week, here are a handful of the names I'll be watching. On Monday, I'll hear quarterly earnings from TD Ameritrade, Hasbro, and Halliburton. On Tuesday, I'll be looking for 3M, JetBlue, McDonald's, Caterpillar, and Texas Instruments. Wednesday will bring Aflac, AT&T, Boeing, Boston Scientific, Ford, and Equifax. On Thursday's a big day. There's 267 publicly traded companies announcing on Thursday alone. I'll be listening for Amazon, Altria Group, Chipotle Mexican Grill, Valero, ConocoPhillips, Mattel, and Twitter, just to name a few. And then on Friday, I'll wrap up the week with Colgate, Palmolive, and Moody's earnings. So that's what's going on there. Lots of earnings, so keep your eyes open. If you're looking at a stock and it has a significant move, just check to make sure that they haven't already announced earnings or are about to announce earnings. If the symbol is very volatile before their earnings date, make sure you have a good grasp of what to expect with regards to earnings before you get involved in that stock, or make sure you control your risk. And then obviously, I like trading moves after earnings because normally the stock, I don't expect Procter & Gamble to be up another $7 on Monday. That stock doesn't move that way. But if you weren't aware of earnings and it suddenly moved 9% in one day, that would be a shocker. I mean, that's to my knowledge, a nice dividend paying stock too. So anyway, let's take a look at the trades from last week. So we always start off each week with the covered call. And I looked at CNX Resources, symbol CNX, Charles Nancy X-ray. The stock was trading for $14.16. And I looked at selling the November 15 call for 37 cents, planning for an 8.55% return over about 5 weeks. This is a November trade. So shares of CNX rose 38 cents in the last week. As the owner of the stock, this is exactly what we want to happen. Our maximum profit in this scenario for the stock is for the stock to rise above $15 per share at November expiration. So that means we would get to keep the appreciation in the stock price up to $15, and we get to keep the 37 cents that we receive for selling the call option. And remember, when I say 37 cents, each option is worth 100 shares of stock. So it's 37 cents times 100. So you're really talking about $37. Plus, the person that buys that call option, if the stock goes above $15, they get to collect the shares of stock that we have because they'll exercise that option. And that closes out the position for us. So it's great. Another positive outcome for a covered call is if the stock appreciates but stays below $15 per share. If that happens, that means that we get to keep the stock and we get to keep the money that we collected by selling that call option. So all we would do is turn around and sell another call option on the stock the next month. So those are the two scenarios. The worst scenario is having that stock fall more than we collected in the selling that call option. So if the stock price fell lower than 37 cents, below $14.16, then we'll be fully losing money, and I don't like that. Not fun. So the next trade, sorry, to wrap up the covered call. The covered call is working right now. We're making money on the stock. I'm happy, so leave it on. If it ain't broken, don't fix it. Second trade is the credit spread we looked at last week on the SPDR, the S&P 500 ETF. When we looked at this, the stock was trading for $275.95. We looked at selling the November 282, 283 call spread and collecting 36 cents. So as of today, the SPY, the SPDRs, finished 30 cents higher. So they closed 30 cents higher than they did last week. This move, it's such a small move in the stock that it didn't really affect the credit spread that we sold at all. In fact, you could sell more of this spread today and still do it for the same exact price, which is 36 cents. So to buy it in, if I bought the spread in, it would cost me 42 cents. That's crossing the bid-ask spread. So right now, I would do nothing other than keep an eye out for any signals that the stock is about to rally. Since we sold the call spread, a rise in the price, especially a quick one, will lead to a loss on this trade. Since this is a November trade, we still have plenty of time to make any adjustments, any alternative trades if the price does move against us. So these include buying in the call spread and selling another call spread with a higher strike. We could sell a put spread against this trade, and we could also even just buy an individual call option to offset the option that we are short. So any trade that makes money or profits when stock prices go higher would be a possible offset for the trade if prices move against us. So hopefully they won't. It always feels weird to bet against the entire market, but sometimes you'll find that you are short the market and you actually are hoping that prices fall lower, even though most of your friends will be secretly wishing, praying, hoping that stock prices go higher. So last trade from last week is the debit spread. We looked at buying a spread on USO, the United States Oil Fund ETF. And when we looked at this, it was trading for $15.12. And we looked at buying the November 14.5, 15 call spread, paying 32 cents, hoping for a 56% return in 5 weeks. Well, shares of USO are down 40 cents, and the stock ended the week at $14.72. So our in-the-money call spread that we purchased is currently mostly out of the money. I mean, it has, we paid 32 cents for it, and it has about 22 cents of intrinsic value right now. So it's not completely out of the money. But if we were to close the spread today, crossing the bid-ask spread as well, we would end up locking in a 9-cent loss. So the way I look at it is I'd stay in this trade. There's 4 weeks left to the trade, and there seems to be a lot more movement that could come from crude oil prices, especially given some of the political issues that are tied up with the Middle East right now, specifically any sanctions that might happen regarding Saudi Arabia. So I'd just keep an eye on this trade. Again, I think crude oil prices could push higher, and that would leave this trade a winner. And I like the idea of 56% in 5 weeks. So today, for those of you who don't know, today is option expiration day, October 19th. So any October option positions that you had are officially closed. They're either in the money at this point or worth zero. And on Monday, many of the options that I look at, many of the stock symbols will list the half strikes, the 50-cent strikes. So some of the trades that we'll look at today are still based on $1 wide strikes. Meaning, let's say if today you go from the $14 strike to the $15 strike, on Monday you might see a $14 strike, a $14.50 strike, and then a $15 strike. So having an opportunity to look at some of these spreads with the half strikes is actually my preferred way of trading. It doesn't affect your actual returns, like your return percentages, but it does have an effect on the actual dollars that you'll outlay and the dollar value of the risk in your account. So just something to think about. I always am paying attention to how I'm using my capital, and I try to manage risk accordingly. So we'll start off this week with a covered call as usual, looking at Caesars Entertainment. So for those of you who enjoy Vegas, Caesars Entertainment, symbol CZR, Charles Zebra Richard. The stock finished the week trading for $10.20. And I'm looking at selling the November 11 call and collecting 30 cents. This will lead to a total return of 10.78% in 4 weeks. When you add in the money that we receive, or the money that you would appreciate in the stock return, as well as the money that we receive from selling this option. So to enter this trade, just to make it clear, you would buy stock for $10.20 unless you already own the stock, and then you would sell the call, you would sell that November 11 call at 30 cents. This trade makes money if stock prices go higher than $11 per share, or if the stock finishes higher than $9.90 in 4 weeks. So the money we received from selling the option actually creates a little bit of a cushion so that you can handle a small decrease in stock prices. So your break-even point on this entire trade is $9.90. So our next trade that we're going to look at is a credit spread. We're looking at Advanced Micro Devices, symbol AMD, Apple, Michael, David. The stock finished the week trading for $23.66. We're looking at selling the November 25-26 call spread at 36 cents. So you'll have a maximum loss of 64 cents because this is a $1 credit spread that we're selling. So the break-even price is $25.36. That's a full $1.70 away from the current price. And the way you enter this trade is by selling the November 25 call at $1.77 and at the same time buying the November 26 call for $1.41. That difference is the 36 cents. That's what you actually receive for selling the spread. Now, this is a credit spread because we are selling the spread. So we receive money. We receive a credit when we sell it. And this spread makes money as long as stock prices stay below $25 per share over the next 4 weeks. And now our final trade of the week is going to be on eBay. It's pretty easy. The symbol is eBay. Edward Brian Apple Yellow, EBAY. Stock finished the week trading for $28.75. And I'm looking at buying the November 30/29 put spread. So this is an in-the-money put spread, paying 63 cents for a maximum gain of 37 cents on the spread, which equates to about 58.73% return in 4 weeks. So you would enter this spread by paying $2.16 for the November 30 put, and at the same time selling the November 29 put at $1.53. This is a debit spread because we are buying the spread, so they debit or take out money from our account. The good thing, of course, with debit spreads is that the most money that you can lose on any option that you buy, including buying spreads, is the amount of money that you pay for it. So 63 cents. And this spread makes money. This spread makes money as long as stock prices close at or below $29 per share on November 16th. So that is it for our 3 trades for the week. Hopefully you're following along, and also, obviously, this is an educational podcast, so hopefully you're understanding. If you're not understanding, if you have any questions, please reach out to me at eric@theweeklyoption.com. Also, if you'd like to receive the option payoff graph Excel file, it is very helpful. It's one of the tools that I use to help teach options, and it's one of the things that really helped me to visualize where I make money and how I make money in option trading. So feel free to email me if you like that file. Otherwise, that is it. Have a fantastic weekend, and happy trading next week. Take care. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.